Everyone, Joshua Rivera, Blockchain Capital. I'm the general counsel there. Really excited to be back at Reimagine 2020.
Hello, everybody. Welcome back to the second edition of Reimagine 2020. I'm your host today, Adam. Glad to have you join us for another exciting discussion with a friend and colleague of mine in the space, Joshua Rivera, General Counsel of Blockchain Capital. Joshua is a Reimagine and fan favorite and now starting to become a regular on the show. So for all of you watching that may have missed our last conference back in May, please visit Reimagine 2020, the website ri2020.io, or you can check out the Reimagine 2020 YouTube channel with all these videos. I think we have over 60 videos, panels, and interviews around blockchain, crypto, trends, industry insights. But without further ado, let me reintroduce you. For those of you that don't know Joshua Rivera, welcome back, Joshua. How are you?
Doing well. How are you doing, Adam?
Good, good. Nice to see you again. Appreciate you taking the time out of your day to come join us and chat with us. So with that being said, for everybody watching, they can go back to the other video and catch your background. But I think, this time around, we can just get right into it, man.
Let's do it.
So let's get into like the not so sexy stuff, maybe right off the bat. Some of the more critical component of our industry, like regulation, right, and compliance. And I don't want to spend too much time because I know this is probably what you do every day. But the last few years, you've been in the space for quite some time. We've done this conference circuit, the meetup circuit. A few years back, we were all talking about regulation and stunting the industry growth, and tokens and ICOs. Well, any quick updates? I know we've all been sheltering in place. We're not going to meetups anymore. We're not going to these events that you and I have been to so many times where the talk was happening. Can you share some insights, of any updates or may not be? But yeah, what's going on in that part of the industry?
Yeah, regulation has not really slowed down. Maybe for a month or so, kind of right when the pandemic hit. But everyone's kind of back to work, and we're still seeing updates in the space. So I think the major thing that happened post quarantine was the Telegram opinion, and then later on the settlement from Telegram. So that was a pretty big deal because essentially what happened was Telegram sold a bunch of grams in a pre-sale to investors using a SAFT format. And there had been kind of this ongoing debate about how that would work. And in this case, I think, not to get into the nitty gritty, but, there's some particularly difficult facts surrounding the Telegram case that made it look like the purchasers of the SAFT were actually underwriting a larger token sale of the grams. And so Telegram ended up losing the motion to dismiss the preliminary injunction, and then they settled with the SEC. So they decided to stop fighting, and so that has been really interesting because now there is still this idea of mutability between something that starts out as a security, but then if it gets decentralized enough to where you're not really relying on the efforts of kind of a manager, a central manager, then eventually you can get to a place where what you're dealing with is not a security. So there's still that idea, but the SAFT in terms of how that fits into that idea is it's looking less and less likely that's going to be a real part of that idea going forward. So the interesting thing that we've seen in response in the industry to that, or I don't know if it's in response, but the industry has been kind of thinking about this in different ways, different kind of players in the industry is what we've seen over the last few months. This is definitely after the last Reimagine session. But we've seen this explosion in DeFi, centralized finance, which has been really interesting. Still lots of regulatory questions surrounding it. But essentially, we've taken this concept of decentralization, which is really a foundational concept for blockchain and for crypto, And the industry is very attuned to kind of seeing if we can push the boundaries of that and make something that has product market fit and is a protocol that people want to use and people want to engage with and interact with, as opposed to kind of like the vaporware of tokens that we saw in 2017.
Well, hold on, you're going down this path already. So, which is great, which we're going to get into like in this session. Yeah. Which kind of leads me with maybe goes into this DeFi and obviously this explosion, right? And DeFi's been around, but like, yeah, we've been seeing the compounds, the Uniswaps, everybody, the MakerDAOs, right, gaining a lot of momentum. So to kind of go back even, and this may touch obviously the regulation, but if not.
Oh, wait, there's plenty to talk about regulation, so we can stay on that for a little bit if you want.
No, but no, exactly. Going into like the application and the utility of these tokens, right? Yeah. And it seems like the new, I've been hearing like these governance tokens. Yeah. Is that any different? Is that, I don't know, for, like you said, pushing the limits. And I'll lead into my second question actually, which is ICOs. Are they a little bit different? And you started touching on it. That's why I wanted to kind of try to set it up in the sense of, one, we have these tokens now that are like governance tokens, and a little bit changing the language and the different functionality or utility. And then the other aspect is like ICOs. And you started touching on it right now, where in 2017, and we kind of see this boom of ICO kind of craze coming out right now in the DeFi projects. But ultimately, this new wave of like 2017, it was ICOs and no product, or like scams and like that narrative of people raising tons of money and not delivering on their promises and getting into that trouble. And we don't need to get into the nitty gritty of like, we've already done that. People can find that anywhere. But now it seems like the projects, and you probably see you've invested in some of these projects where, or even like the entrepreneurs and founders that are watching need to learn about putting a product out there now, or at least having some deliverable and maybe getting through that scam or not scam, but just the ICO kind of regulation, getting away from SEC stuff. So yeah, if you can touch on that, like the governance models now, which kind of leads into product market fit. Projects are holding off on raising, launching an ICO and building something, and then raising or whatever, pre-seed and all that.
For sure, yeah. So the interesting thing, governance tokens, like as a concept, is not new, right? Lots of people have put out like governance tokens, and the idea kind of being, we'll call it kind of pre 2020, even though this idea was around before, or the competing idea was around before them. But the idea around governance tokens is like they're valuable because they allow you to make decisions on a network, right? And kind of direct how a network does things. So for us at Blockchain Capital, that's always been a kind of suspect premise of like, okay, so yeah, I get to make the decisions around something, but that doesn't make it valuable, right? Like, I can, have a chess club and like have governance in that chess club. It doesn't mean that like that chess club has inherent value to anyone. Now, maybe if enough people are part of the chess club and they want to start like paying dues to be in the chess club, then it becomes valuable. But in and of itself, governance doesn't necessarily translate to value. So what we've seen in DeFi that's been really interesting is we've seen prior to some of these governance tokens, for example, in the case of Compound, right, we've seen an actual protocol that has achieved some level of product market fit, right? Even if that market is still limited. But the idea being that what we have is a lending protocol, right? And all of this, really the DeFi kind of explosion began with decentralized lending, where you provide an asset, and began with MakerDAO, and you were providing an asset to yourself, really locking it up as collateral and then lending against that. And where it has come to now is you can provide an asset that is then part of a pool of assets that others can come in and borrow from. And so we've got things like liquidity providers, we've got automated market makers that allow us to engage in this lending and borrowing activity much more freely. And it turns out people really want that, right? Particularly, and this is where you talk about kind of market size right now, particularly people who, traders who want to trade on leverage, who want to borrow and be able to trade because they believe that they can make that trade work, and they can recoup profit based on, above that leverage. So then what was happened is we have these lending protocols that now we're layering governance on top of in a decentralized way. And so the theory is that, and we're still kind of seeing if it's going to prove out in industry, right? But the theory is that as these lending protocols gain additional liquidity and gain additional lenders and borrowers and liquidity providers, there are fees that are generated at that level. And if you, in particular, like these fees are being paid out, they're either being paid out in kind of the asset provided to the pool or in a governance token. And the idea is that these governance tokens can then be used by the governance holders, which are supposedly like a disparate set of people, not just kind of one team. These governance tokens can be used to determine what do you do with those fees, right? You take those fees and then you pay out a dividend in a particular asset to the governance token holders, right? And so that's kind of real. There is lending activity. There are, people are willing to pay interest on borrowing, and you can take a fee on that, and then you can decide what you want to do with that fee. So that's the interesting part, and that's kind of what gives governance, or potentially gives governance tokens, value. And again, like all of this is very experimental. So that's kind of like the idealistic viewpoint of it. But what makes it interesting from a regulatory perspective is that if you can credibly show that there's no one entity that dictates the terms of that governance, right? If you can credibly show that, for example, the Compound or the Aave team, or even the Uniswap team, right, that they don't have control over the decisions that are made, with that interest or potential interest, those payments or those dividends, then all of a sudden, when you as a user are using this protocol, you're not relying on any one particular individual. It's a community that's making decisions. So it becomes much more difficult to conceptualize how the token itself represents a security, or at least kind of represents a security that, or kind of represents an investment contract in the sense that, like, whose efforts are you relying on, right? The protocol's built, it works, and if a number of governance token holders make a decision to do one thing or another, there's no central person to dictate that decision. So we're super interested in that, and from a regulatory perspective, it is a fascinating experiment to see if as a good friend of mine, Jason Somosato, Counsel at 0x, put it, if governance tokens can be the antithesis of securities. We'll see.
So I guess time will tell. But yeah, no, it's pretty interesting. I mean, I haven't heard too much on some of the regulation on that front, but it seems like a lot of these protocols have found a way to incorporate these various, even like governance tokens, into the protocol and for the users.
Yeah, we'll see. I mean, the thing with regulation, and people have to realize this, is regulation runs kind of, in almost any industry, regulation is going to run at least a few months behind innovation, but particularly in our industry that is so novel and so kind of distinct in terms of how things work, being blockchain technology, new-ish technology, and being so small. So our industry is relatively small compared to the other financial markets and capital markets that regulators kind of work in. Those two things make it so that regulation is going to take at least 12 months, sometimes 18 to 24 months to actually catch up with what's going on. And that means that, like, we like I'm sure regulators know what's going on
Yeah.
in DeFi, and they're trying to kind of get their arms around it. But it's going to take them some time between now and when they can finally figure it out, for them to say, hey, this is exactly what I think about all this, and for them to kind of develop their legal theories.
And by then the product might be a little bit different, right? Like,
yeah. Well, exactly. The innovation happens so quickly that by then a few things could have happened. That, you know, any particular product or protocol that they're contemplating might not be that important to the industry anymore. Innovation could have shifted. The way we use these things could have shifted. Now we're seeing kind of the rise of these aggregators that sit on top of the automated market makers. And they essentially allow you to put capital with them and then find the best yield from those liquidity pools and automated market makers. So the question there is, you know, if one layer doesn't implicate securities regulation concerns, does the next layer? Because you can, as Howie told us, right, like you can deal with an underlying asset that's not a security, but still sell something called an investment contract that is a security, right? Just because the oranges themselves aren't securities doesn't mean that you can't package them in a way that implicates regulatory concerns. So we're just seeing innovation happen at a really lightning pace right now. And it's gonna take some time for regulators to figure it out. So part of our responsibility as lawyers who care about this industry and who care about making it as successful as it can be while still kind of being regulatorily palatable, is to try to like think ahead, you know, 12 to 18 months and say like, here are the issues that regulators are going to care about. Here are the things they're going to worry about. How can we address those things now, so that we can continue to build this ecosystem once they kind of catch up?
Some due diligence, right? I mean, kind of prepare as much as possible, try to play by the rules. Do they reach out to you, or you know, is there any kind of not direct, but you know, communication groups, channels, individuals on the you know, working with the state or the government? You know, do they try and reach out to you to figure out? Do you partner up with anybody to sandbox?
Yeah, it's a great question. Regulators, at least to us, Blockchain Capital, do not reach out to us directly. We have some good relationships with several regulators, but it's usually us, you know, taking the initiative and saying, hey, here's some interesting ideas that we're seeing, and here's some kind of not so favorable responses that we're seeing from you, and we'd like to talk about it. So a lot of that happened in the ICO space in 2017, 2018, where we acknowledged that a lot of what was happening was kind of vaporware and really unfortunate for the industry. But some of our portfolio companies were companies that we believe kind of did it the right way and should have been thought of differently. And so in those, not in those cases, but with that framework in mind, we definitely engage regulators on a regular basis and say, hey, we think this industry is important and we think it needs space to grow. And we think that there are things that you can do positively to help that happen while still kind of maintaining the protections that you care about. So, that's still an ongoing discussion.
Which is consumer protection, right? Like making sure, you know, and on the bigger scope too, which this maybe doesn't play a part yet, but the market, financial markets, you know, like consumer protection, like, you know, shit doesn't fall apart, you know, damage, you know, various.
No, that's absolutely right. You just actually articulated two of the SEC's three kind of like core like reasons for existence, right? The first is investor protection. The second is the you know, to assist capital formation, and then the third is to ensure fair and efficient markets. And so all those, like that combination of things kind of comprises the SEC's kind of soul, but the one they care about the most is investor protection. And that kind of like if you win on helping capital formation and making markets particularly efficient and fair, no one says like, hey man, the SEC, you did a great job. They're just like, yeah, that's what you're supposed to do. But if you lose on investor protection, then, you know, this is like the Enrons of the world and the Bernie Madoffs of the world. Like when those things happen, everybody kind of like points their finger at the regulators. Now that's to talk about the SEC. There are other regulators at play that care about other things, right? So when you think about the Treasury Department and FinCEN, the Financial Crimes Enforcement Network, which is underneath the Treasury Department, they don't care about consumer protection, they care about national security. And their kind of primary concern is opportunities for money laundering and terrorist financing. And so what I'm seeing, this is kind of my personal opinion, and to kind of give a late disclaimer, like, none of this is legal advice, of course. And these, what I'm saying doesn't necessarily reflect like any kind of official position of blockchain capital. But what I'm kind of seeing is that, and what I think we'll see is a shift from the SEC being kind of the most critical regulator to the space to really the Treasury Department and FinCEN being the much more critical regulator. Because what DeFi does really well, I think, or in theory, what it does really well is it kind of dispenses with a central actor, which is really what you need for securities regulations in most cases. And not that there can't be central actors that do things that ought to be regulated by the SEC within DeFi, but for the most part, we're not talking about a kind of like a central issuer of a token in the same way that we were in 2017. But what FinCEN cares about is there something that exists that facilitates the ability of someone who is not a good person, right? A bad guy or a bad girl, being able to launder money or being able to finance terrorism, right? And so we just saw, let's say it was last week, the DOJ seized Bitcoin accounts from terrorist organizations. And I think we're going to see more of that. And we're going to see some attempts by that regulator to fence in the really kind of the financial market that exists within this ecosystem. That, I think, is kind of the scarier part, is that obviously, like, we in the industry, we don't want, we're against, we're against terrorist financing and money laundering. So are, international banks. They're also against terrorist financing and money laundering. But, money laundering and terrorist financing happen through the kind of international banking system and happen with the US dollar more than any other asset. But that, so my point is just to say, like, we're not trying to kind of be unregulated, but the concern is that when you don't have a central entity making determinations, it's very hard to get people to comply with or to even just provide AML information or provide information that could identify them for purposes of making sure that they're not on a sanctions persons list or sanctions list for nations or specially designated national list. And I think that fact is going to make the Treasury and FinCEN be much more concerned about something like DeFi than they were about something like ICOs. So we'll have to watch that one really carefully. And again, like, part of our responsibility as lawyers in the space is to do everything we can to still satisfy the desires of the industry in terms of being decentralized and providing protocols that also protect privacy and allow for these kind of really innovative financial products to exist. But still address the concerns that the policing force, as opposed to like the civil force in the SEC, but the policing force in the Treasury Department are going to find particularly concerning.
And do you relay this back? And I know we probably talked a lot more than you want to do on this stuff. But,
no, it's great.
Do you relay this back to these projects that you see that are kind of like on the cusp of regulatory issues, concerns? We kind of relay some of this, communicate with founders and projects. And the reason why I started off with this is because there was a lot of regulation and talk about tokens and ICOs and all this, and things have kind of matured. Right now, there's more products and people delivering, and we have people watching right now that may be starting to build a product, and they need to think about some of these things where as a developer and engineer, you're thinking about this cool idea and innovation, and you might get stunted somewhere. So just kind of either be prepared or do your due diligence on what you're building, how it affects not just the innovation part of DeFi or blockchain, but national security, right? And you're going to run into some of these things. So I wanted to touch on that stuff, which kind of leads me into what's been going on now. You guys have invested in a lot of these staples in blockchain, your Coinbases, right? Your Anchorage, your BitGos, Bison Trails, right? So like, I want to zoom out a little bit too for the audience here. You guys have been investing since 2013. At that point, or even in 2012, there were meetups going on in the city, right? Like the Jed McCaleb and like a few other big names that have gone on to start these companies. And we didn't know how to like buy Bitcoin at that time. Very cumbersome, right? Or no exchanges, no wallets, no private keys, custody. And so, I want to zoom out a little bit. You have this portfolio of projects. Here we are in 2020. Are we in a good spot? I mean, the teams that you've invested in, validator infrastructure layers, stuff like that, infrastructure, ground foundational parts to what we need. So give me some insight onto like how that's been going. We're here now. We have these big companies, and where you see us going, moving forward, I guess.
Yeah. And in some ways, you could say that it's as good as it's ever been. Kind of all the macro circumstance surrounding 2020 has really brought acute attention to natively digital things, right? PayPal is doing incredibly well because everyone is shopping online, right? Zoom, what we're doing right now, like everything that kind of like digitizing the way we do life is particularly attractive, and people are taking notice. So, that coupled with, we've had some big names talk about the importance of having position in Bitcoin, right? To give one example, Paul Tudor Jones, putting significant amount of his funds assets into Bitcoin, and the recent public company that just bought $250 million worth of Bitcoin, I think Mark Share, I think is what it's called. We're seeing those things happening, and that coinciding with people being quarantined, people not able to interact physically, people not able to use like actual dollars. And then on the government side, we're seeing this enormous printing of money. And so one thing that we're hearing from friends who are not even in the industry, but we'll get questions like, wait, so if the government can just like print all this money, like why am I paying taxes, right? Like, why can't the government just like print the money it needs? And that's kind of a joke, but the idea is that there's a question as to what happens if the government can just continue to produce what's supposed to be the global reserve currency. I think we think in the short term, that so many countries, so many people use the US dollar that we're not going to see kind of significant structural concerns there. But in the long term, we think this plays really well into the industry. And so all of those things kind of combined to have really made us excited about what we've invested in. Like you were saying, we've invested in some of the major infrastructure plays in the space.
And talking about like layer ones, exchanges, wallets, which are kind of starting to blend a little bit. You have these validator infrastructure, companies as a service. And you have you have a lot of these in your portfolio, which is, we're not even at the application layer yet. We're talking about, are you still looking at layer ones? Like blockchain?
I mean, look, like we're always looking at, we're always looking at everything, right? Like we don't, we look at every kind of vertical in the industry and every potential application of the technology. Now there's some that we don't invest in because we don't believe there's value that will accrue there, at least not in the near term. Near term meaning, like 5 to 10 years. But yeah, I mean, so we're still really proud of our positions in Coinbase. We're still really proud of being lead investors with Anchorage and Bison Trails. We think that those things are still going to be critical, right? Those things being infrastructure. We just had an investment in a company. We haven't announced it yet, so I'm not going to say the name, but company that is doing data analytics on mempool activity, which for those who don't know, the mempool is like kind of the pool of transactions that are waiting to be confirmed in a given block. Not all of those transactions will be confirmed. And what we're seeing now is that we're seeing all of this congestion on Ethereum as the layer one, and gas fees are skyrocketing, and transactions. It's harder to know if your transaction is going to get confirmed. So we think that there's still lots of work to be done on the infrastructure layer, and everything that's happening now is kind of shedding light on that.
And you mean, are you talking about, like you just said, like scalability, throughput, like security, yeah, right?
Yeah, all of those things are important. There's still this kind of like raging debate of, is Ethereum the one? Like, is Ethereum going to be the chain that is able to support all of this new activity in DeFi? Is it going to be able to scale? Or, like our gas fee is going to be, $1,000, right? Like how are we going to scale? Is it going to be another chain? So we're still very interested in that. We believe in Ethereum. We have a position in Ethereum, but we're also interested in what else is happening at the layer one kind of level.
And to go back to maybe some of these portfolio projects, or not, or maybe like moving forward, it probably makes it that much important to invest in projects that maybe be interoperable or have the event or option of switching chains,
Yeah.
for these reasons, right? Like you can invest at, what was it, like Fat Protocols, and I forget what that article was, but investing, at the ground level, or investing in some of the applications on top, giving you some diverse, potentially moving out of Ethereum, let's just say, because that's just for the sake of example, to something else like the NEARs, the Hederas, whatever. So you're looking probably at a diverse, projects that can jump around if need be.
100%. Yeah, I mean, so yeah, to like that the answer to that question kind of like has a couple different perspectives, right? On the one hand, like we still look around and see Ethereum dominating the developer kind of market. Like if you're not if you're a serious developer, but like the vast majority of serious developers in the space still develop on Ethereum. Now they may do other stuff somewhere else, or there may be some like really quality, really key developers developing on other networks, but it's still Ethereum. So we see that. On the other hand, we see some really interesting and really kind of important innovations happening on other layer ones. And so the question is like, how do you pick the winner, right? Like the best technology doesn't always win. Sometimes it's like the best meme value. And sometimes it's like familiarity. Sometimes it's brand stickiness. Oftentimes it's liquidity, right? Google wasn't the first search engine. But so what we try to do as best we can is we try to invest horizontally, right? So that's part of our investment thesis. We want to invest in things that provide services to a disparate set of protocols. And so that's kind of the idea behind particularly an investment like Bison Trails. Bison Trails is going to be able to provide services to a number of different blockchain layer ones. And so we're hopeful that what that means is we don't have to decide whether it's, Algorand or Hedera or Cosmos or Polkadot or whoever it is, right? We don't have to decide who the winner is, but hopefully we can still participate in the upside. If two of those or three of those are very successful, hopefully our portfolio companies will be, and we will be as well. Who knows, right? But it's still a really important question. And I think it's going to take some time before we see, before we're able to kind of actually determine where the lines are going to fall in terms of winners and losers.
And how does these, not the decisions, but these projects and teams and kind of what we just talked about, how does that affect, we have a lot of people watching from beginner, novice to expert globally. How does this affect like the retail and institutional investor or user, right? We just talked about some of the infrastructure stuff, like scalability issues. For those watching, right now we're very fortunate to go grab a coffee in like 2 seconds, right? Where some of these transactions using crypto take longer, meaning centralized systems are working great. And we're going back to this decentralized world of automation, which it's not quite there. But what we're saying, and so what I'm asking you, I guess, is some of these decisions that we make, how does it affect the end user, the retailer, or the institutional side? I think a faster chain, right, can help some of the transaction speeds. Some of the infrastructure plays on the institution sides of custody can be more secure, and they can get in.
Yeah, no, it's a great question. I think that so there's two things, right? So on the retail level, the retail market that we see for these things is largely an insular market that is like crypto native and crypto, or at least crypto familiar, if not crypto native, if you don't like the term. But so we still have a really limited set of people to kind of like go out and promote products and promote services to on the retail level, because my mom doesn't understand crypto. She's not gonna like get in there and like start staking on Polkadot or whatever the case may be. And so until but she uses the internet, right? Like that, the retail market right now is very limited. What I think is necessary for the industry to grow is we need institutional comfort and assurance. And so a few things, or
are we talking about investment, or like VC style, or like just into Bitcoin, or just a whole new wave of, because we're talking about Web 2.0 and Web 3.0. We're talking about advanced technologies and plugging, or all of our mindsets is like, this is what we're used to, a credit card, going to the bank, to send money, and so we're talking about super fast, comparable, and are relatively cheap as well. So when we talk about institutions, probably, I'm sure it touches all of it, but are we looking for them to dump money like family offices, which we'll get into? I have another question, later down the road on that, of what's their involvement? You're probably going down that path, but just to kind of get the nitty gritty on what institutional looks like.
Yeah. So what I mean is both from the investing side. So we want institutions to be investing. But I think what's going to be really interesting is when institutions start engaging protocols, and they are not going to do that by themselves, right? An institution is not going to buy a bunch of ledgers to hold digital assets themselves. They're not going to get MetaMask accounts so that they can MetaMask wallets so they can play on DeFi. So what's really important. So the first part is happening already, where institutions are investing in blockchain capital, or investing directly. PayPal invested in one of our portfolio companies, TRM. Visa invested alongside us in Anchorage. So we're seeing institutions invest, but they're not kind of directly interacting with the protocols or with the technology. And I think for that to happen, there is kind of still some of this institutional advancement that's needed. So you think about brokerage services for those institutions, right? So that's where hopefully custody providers will be able to say, look, I'll hold your digital assets and I'll provide these brokerage services to you, so that you're not just sitting on assets, but you're actually putting them to use, whether it's lending, whether it's staking. And so I think that's one of the frontiers. Another one is again, thinking about how the inner workings of a blockchain affect transactions, right? So institutions need to have confidence that if they try to make a transaction on the blockchain, it's going to go through, right? If they hit send on a transaction and they're having to wait and they don't know why it's not going through, it's not being confirmed, they're not going to want to do that. And there are service providers who can step in and say, look, let me help you make sure that when you engage on the platform, you're going to have the type of results that you expect.
Are there any insurance products or projects that you're seeing on ensuring custody?
Yeah, ensuring custody. No.
Is that even possible in the sense of I guess, I don't know, there's non-custodial, custodial, but I feel, we don't want to manage our keys because we're not sure maybe the proper way. At the same time, I'm a big bank. I'm not, or whoever the institution is, I'm not going to give over my keys to, because now it's just going centralized. You're that concept of like, my money, my keys. And so have you seen anything like that, or do you think that's even possible to have an insurance policy to kind of get things flowing a little bit?
So insurance is a great topic, and we actually think like as like a top line thesis statement that insurance is one of the best ways to access DeFi, and I'll explain why in a second. But to think about custody, so what we've seen is large international insurance underwriters begin to get comfortable with some of the custody providers. So your BitGos, your Coinbase custodies, and your anchorages have been able to secure reasonable insurance protection for at least their hot wallet holdings. There's a debate as to whether you need insurance for cold storage or not. But what I have seen, and I'm not an insurance expert, but what I've seen is mostly kind of fairly reasonable coverage on live wallets, live hosted wallets. But that's happening from centralized international insurance underwriters, right? Lloyd's. What's more interesting than that happening is if we can formulate decentralized insurance protocols. And so one company that we're invested in called Nexus Mutual has developed a platform like that where you can buy coverage on a smart contract, right? You can buy coverage on a DeFi protocol. So we think this makes a lot of sense. It makes sense for developers who are heavily invested in the success of a protocol that they're working on. Sorry, not the developers who are heavily invested in a protocol that they're working on. Makes sense for investors if they're also invested in a protocol to buy insurance.
It's like a peace of mind, right? Just when we're talking about adoption and usage and these are just some of the my bank covers me. Although I haven't been in the bank, walked into a bank in about 2 years.
Yeah.
But you get the security, right? You have fraud and all these other certain benefits and features of using these products, and I feel like some of that would alleviate or at least have some people feel safe. Mentally of like, all right, cool, I can try it. I'm covered a little bit.
Yeah. So what's interesting is that, I mean, even more than just like when you think about insurance, you think about like, well, what if my house burns down, or what if somebody steals my stuff? And so you have insurance for things like that. When you're talking about decentralized finance, there is kind of there is maybe like a theft risk. What you care more about like a black swan event, like was it Black Thursday, right? Or you care about if a protocol breaks, like Yam did, like 24 hours or 48 hours had $1 billion in valuation, 700 million locked up, and then because of a kind of a miscoding for the governance protocol, they weren't able to make a governance decision that they needed to keep the protocol going. And the smart contract ended up printing like a 9 or 10x the amount of governance tokens that currently existed, and all of those governance tokens, those newly printed ones, went to some vault that no one could access. You could not vote for the change, right? So things like that are really more the concern in DeFi, where we're building things that are highly experimental, and we hope that they work, but sometimes they break. And if they break, there's the potential that there's significant value that is locked and possibly lost when that happens. So what something like Nexus Mutual, and there are others, does is they allow you to buy coverage on the potentiality of that breaking. And that way, if that happens, then you have some sort of recourse. But what's interesting about it is that they're doing it in a decentralized way. So instead of having to go to Lloyd's and like try to explain to a Lloyd's adjuster or underwriter, like, hey, here's how DeFi works, it's decentralized, and like they're gonna throw up all over you, right? They're gonna be like, get out of my office, please don't ever come back. What we're having natively digital, natively decentralized protocols that are allowing us to engage and experiment in a way that also protects us.
Interesting. And I know we got a few minutes left here, so I just got a couple questions. One of them we already touched on, and we don't have to repeat it, but just institutions. And one thing, are you seeing, in just a few seconds on it, are you seeing a lot of more traditional family offices and traditional VCs, looking into the space more? Meaning, we just talked about some staples of the industry. There needs to be more work, right? There's a lot of other products and things that need to be hammered out. But are they kind of obviously seeing the future, to see the Coinbases, the layer ones, the wallets, exchanges being developed? Are they, getting more interested in investing?
Yeah, they are. It's like, this quote goes around Twitter all the time, like slowly, then all of a sudden.
Yeah.
And we're still in kind of the slowly phase, but we're seeing much more institutional involvement. The fact that Visa and PayPal and other institutions have directly made investments into companies building the ecosystem is astounding.
They have their own teams. MasterCard's one of our partners. And they care about the payments, but they're also looking at stable coins and like other projects that you just brought up. Didn't mean to cut you off.
No, yeah. So we are seeing that, and it's exciting, but we always have to kind of temper our excitement with look, there's still a long way to go, things are still going to break, and so we still need to kind of continue the slow and steady pace, and hopefully, as we build, it'll continue to be interesting to institutions.
And I have two more questions. One, and the first one is, and this probably relates maybe to traditional investors and institutional stuff, on the aspect of like portfolio construction, in the sense of like, and this could be personal, right? Your personal views. How do you determine if I'm going to go like invest VC style into a project? Am I going to go Bitcoin, or am I going to go like altcoins?
Yeah.
Like that kind of variety. Like, do I get the underlying? Do I just ride Bitcoin? Do I, and obviously preference and risk tolerance play into consideration, but maybe at a high level, like what are your thoughts there on getting a piece of the pie, and how do you do it?
Yeah. So we still love Bitcoin. I mean, we still think that Bitcoin is by far the most proven protocol in the industry, right? And it's simple. It's just become the store of value that represents the industry. And we think there are good reasons for that, right? Mathematical scarcity and divisibility, and recognizability, all those things, right? That make for a really excellent and lasting store of value. We think that Bitcoin has it, but in many ways, it was like it's the one that people know the most, it's the one that has the highest market cap and people trust the most. So we're still very long Bitcoin. But what's also kind of really exciting is the idea that Bitcoin introduced that is being improved upon and being developed, which is the idea of programmable money, and how can that change our everyday lives. And so we have a position in Bitcoin, obviously, but we also try to have exposure to the rest of the industry in various ways. If it's like a particular team that's building something really interesting, or if it's kind of the horizontal way that we talked about, and sometimes it's like, look, we want exposure to DeFi, but we want it as as risk adjusted as possible, which means that like maybe we won't invest in a specific token, but maybe we'll invest kind of around the ecosystem in ways that we think will also benefit as DeFi benefits. So Ethereum is Ethereum that thing? Maybe not. Like maybe DeFi explodes and it's good for Ethereum. It seems like it has been, but it's not the gains in Ethereum have paled in comparison to like the explosive gains in something like Compound. And so we're still, we always think about like what's the best way to gain exposure to a particular asset class, and particularly in industry vertical.
Cool. So you kind of just take a holistic approach and see, what the effects are of investing in one area, how we can sprinkle it amongst, various projects that get a little bit of taste, but like you mentioned, not as much of the upside, but you're managing your risk there. So appreciate that.
Yeah, definitely.
And then my last question here, we got a couple minutes. This pandemic, right? There's been recessions, there's been depressions, over the span of our economy. And it's pretty interesting. And we have a lot of people watching this, students and developers and founders and people developing things at this moment, trying to pitch, trying to raise. It's pretty interesting, and I kind of want to shed some positivity on kind of where we're at with this pandemic, right? And what are your thoughts, or what are some tips and advice? And where I'm going with it is that I can name off some names that have been raised during a recession or depression, which is your Apples, your Slacks, your WhatsApps, your Pinterest, your Instagrams, Square, Uber, right? A lot of these things came out. Everybody thinks the markets were great, but they came out in 08. They came out, years, in the dot-com bubble, and even in the 80s and 70s. Apple came back twice, So what are your thoughts? And you're seeing a lot of applications right now, and probably a lot of people are down, like, money's not flowing, like, I don't know, shit's hitting the fan, like, my point is, like, let's not give up, right? Like, so what are what's some insights that you can shed for some of these young people, or not even young, but just entrepreneurs that are building something and are having a tough time? And I just named off, like, WhatsApp, all these companies that came out when shit wasn't good.
Yeah. Yeah, I mean, look, like, the way we look at the pandemic is in times of acute global upheaval, there's great opportunity, right? Because it forces people to innovate. It forces people to change it changes how we look at the world. And anytime there is that kind of extreme change and extreme kind of like wrestling with difficulty and adversity, a lot of times people do things that really kind of change the world. So we think crypto in general is hopefully slated to be one of those things, but in particular, we think that there are a number of players in the space that are taking advantage of what is just a very unique time in history. One, because of kind of like market stress and economic stress. Even though markets don't seem stressed all the time nowadays, but the other is just like the pandemic conditions that are kind of imposed on society due to there being this just like really virulent strain virus that's going around. So we're for us, this is actually like the moment to pay attention. It's the moment to engage and to like lean forward, because this is when we're going to see, things that are small now, things that are kind of not seen or observed, are going to become, we believe, really important and kind of the major things of tomorrow. At least we hope, right? There's certainly the opportunity for that. So we're hopeful, and it's happened before. We're hopeful that it'll happen again from our industry, and that's why we get up every morning, and we're excited to kind of see what the day holds.
Exactly, and I think it also brings to an opportunity to kind of evolve too from what you've been working on, and don't be afraid to kind of make a change, right? I think Blockbuster could have bought Netflix, I think, in 2004, right? Did you see that?
Yeah.
And for like $50 million, right? And
yeah.
they did. And so, we all know that story. Blockbuster went to zero, and Netflix is worth, I forget, $6-7 billion. And so it just goes to show that these markets change drastically. Black swans are an issue, or you got to think about these things that hit and take advantage of it. But it seems like, especially in the blockchain space and these startup founders that may be a little bit down, just to keep working, right? And if you have a good product and a good team, like, you're probably in a good position to continue on. And so, I just wanted to touch on that as we finish this discussion.
Yeah. One thing for founders to remember is, like, right now is a time where people have a lot of problems, right? And so, and one of your jobs as an entrepreneur is to find problems that people care about and are willing to like pay for solutions for, and create the solution for that, right? That's product market fit, problem solution fit, right? And so yeah, a lot of people are like struggling with a lot of things, and one of the, a lot of those things are financial, and there are going to be opportunities to address those difficulties, and hopefully we can find the teams that are going to do that well.
Perfect, man. So I think we're up on time here. Everybody that's watching, please visit ri2020.io for this full discussion and the rest of our interviews. Feel free to catch Joshua in our first discussion back in May at the YouTube channel, Reimagine 2020 as well. Joshua, thanks for visiting and talking with us as always. Appreciate you taking the time out of your day to come chat with us and share your perspectives with our audience.
Yeah, it's great to be here. Had fun as per usual. So yeah, stay safe, everybody, and yeah, we'll see you.